Morning, everybody. Hope you guys are doing well. Today we're looking at NASDAQ. The reason why I delayed the stream is because we have 10 a.m. news today. So I'm waiting preferably for that to drop to look for any moves after that. But as of right now, bullish on the higher time frames. I'm looking for that 1800 Monday, February 3rd swing high to be tagged into. Then we also have an hourly imbalance above that, which I'm favoring a possible run up into because we have the breaker in here. So overall bullish PA. We've got this bisi here dropping down into it, plus the bullish order block, and then displacing away and holding this down closing candle as well. So order flow is bullish from what I can see. Now 930, I wouldn't say this is a clear 930 manipulation. So that's the only reason I decided not to stream in the mornings, because if this case, this to me looks like 930 expansion. It doesn't look like it has a clean Judah swing and then trade back up. I'm not saying this is impossible to trade. What I'm saying is, if 930 is expanding, we then expect 10 a.m. to potentially manipulate. And for those that, this is a little laggy. Let me see if I can fix it. For those who are new, excuse me. Oh, it's because my Wi-Fi is all messed up. Let me actually, give me 1 second here. For those who can hear me, you'd favor then if 10 a.m. manipulates and then expands. It can expand, but I'm not going to take the chance, right? There's going to be some things that you can control in this, and you will know with great probability where it's likely to go to, and some things that you don't want to take the chance on. So yeah, 10 a.m. news in this case could expand and just shoot us up to this buy side. Maybe I missed an entry here at 951. There's going to be other times where it comes down and tags that again, and then it comes back up. There's other times it's going to manipulate all the way down, take the stops, and then come back all the way back up. And there's sometimes you got to just discern whether or not you want to participate in that. And for me, I know majority of my trades are what I like to look for on NFP week is as post NFP itself. So on that 8:30 news day, a lot of times after NFP comes out, you can find decent trades on that day. Obviously, Thursday, we're not going to be looking for anything. I'll have a little short spiel about low probability days. But as right now, 5-minute order flow is all bullish. This candle will probably close, and then the 10 a.m. candle will drop into the 5-minute bisi there, and then expand back up. But as of right now, these are the levels I have. I'll put that in predictions chat. That's not what I wanted. So here's your 10 a.m. news. And it looks like it's just going to fly up to the buy side. There's your buy side tag and the hourly previous day high. But no big deal. Anyways, so as we continue to watch this, I would just confirm that order flow is supposed to be bullish. I'm liking. We can see the profile today was so weird as well. Similar kind of profile, that's why I didn't stream earlier on. There's no really complete profile in this. 10 a.m. could be the high of the day. We drop back and consolidate in the range, or we continue to expand. I don't really know at this point. But I know Silver Bullet a lot of times has an entry model. So I'm going to wait to see if there's anything given there. And then potentially take one on demo on live stream. But I wanted to mention something about low probability days before I forget. Because January is such a good example. We're finally in February PA. We can finally do stuff. We probably have more streams, more executions per week, things like that. But with low probability days, you need to have a protocol that you follow. There are going to be low probability days where you know, or not know, but you understand that with a great deal of certainty where price action is likely to go to. Meaning you have a bias and a draw on liquidity on low probability days. But you must learn how to opt out of trading. Right? That seems like a very weird thing to do, is if you know where the draw on liquidity is for that day, but you choose not to trade. And it's an important skill that you must have, because low probability days, you're not going to know. The conditions are already not in your favor, where you're very, very likely to take a loss, right? That's the definition of low probability, is you're more likely to take a loss in this situation than you would a normal situation. You're more likely to read it wrong. You're more likely to have your bias wrong. And I think a good market truth that you need to understand is that every day looks high probability until you take a loss. So trying to come to the higher time frames and expecting you're going to see it blatantly spelled out, low probability in front of you, without having the experience of actually knowing what it looks like, is just a misconception. Because everyone's going to look at it differently and think that, oh, just because, like on Monday, for example, we have this large gap down, and I know I don't want to be trading that scenario, even if I know where the draw on liquidity is. Other people are going to look at this as, oh, there's a large gap, I can trade into that. And then you're going to falsely associate wins in a low probability condition with you're going to get overconfidence from it, because you're going to take a win in a condition that you shouldn't have been trading in. And then you're going to misassociate that win with actual skill. And that can be detrimental later on down the road when you actually take a loss on a low probability day. And then you have this major swing in your emotions, right? So learning how to control that urge to trade is going to be very, very important. And you've got to practice it, right? So I think the best way to practice it in the beginning is by simply not looking at it. Simply do not look at the price action on the low probability days, because everything that you can learn on a low probability day can be learned after the fact. Meaning when you go back into the charts and you screenshot price, you can go back in and learn everything that you need to learn from that day. I think as you progress, then maybe you want to tape read and find a bias on those days and just see physically how difficult it is. I mean, that'd be a bad idea. But I really don't think, if it's something that is going to produce longevity in the game, that you need to be doing it, or you should be doing it at all, right? So for example, trading swing to Z days. You may know how to, and you may know where the draw on liquidity is for a specific macro or even the entire day. But I'm most times choosing not to trade those days, because in terms of the longevity it's going to provide for me, it's just not optimal compared to trying to trade a high probability swing to Z, or high probability classic London protraction or New York open reversal. So at this point, best case scenario is we find a 1 minute bisi forming, preferably within a mitigation block, and you can target that hourly imbalance. But at this point, the high of day could have already been put in. Remember, if you look for London close, it's between 10 to 12. That's where you expect your new high or low on the day to be formed, depending on the profile. Now, in this case, we got a really sloppy, I don't even know what kind of profile this is. It's dropped down during midnight, then trades up back into the range. It's just a very sloppy market maker buy model, with all honesty. And you can do things, I guess, with take the last manipulation leg to SMT on there. No. Well, then your last manipulation leg would be here, I guess, at an absolute minimum. That's quite far up. But if anything, you can just do your opening range. I did a video on this, I believe, in Models and Reviews, if I'm not mistaken. Models and Reviews about the opening range. If you've not watched that video, I suggest you go and watch it. But you want to take your highest high and your lowest low of your opening range, and you can use a -1 standard deviation to find your estimated targets, typically for the day or for the week. So if you saw yesterday, here is your lowest low and highest high during the opening range, then your -1. Just go watch the video if you haven't already. It's a very, very good video. You can get weekly standard deviation targets as well. Also, if it lines up with things like the last manipulation leg, you've gotten a very, very nice targets all in there. But yeah, so I mean, based on the projection, you're already getting a little bit further up above the new week opening gap and above the hourly imbalance. Let's look at chat really quick. Fatal cooking as usual. I love it. Almost a soup there, 9:30 soup, all the way up to new day opening gap. I love it. And then Grim with little scalp off of the tiny 1 minute fair value gap up to Asian high. I love it. Looks good. So yeah, this moment in time, we're still in the end of macro time. There's not been any 1 minute imbalances. You can use probably 15-second imbalance if you wanted to use that. Yeah, some tiny ones in here. VI, inefficiency, which on all of which you could be using. Not my cup of tea for this example though. But yeah, I mean, you could actually look for up here, 21,807 as potential opening range standard deviation. And then we don't really have any clean manipulation legs in here. Like I would say, realistically, it's this entire thing, which is quite far up. There's your expansion off of the 15-minute imbalance. Actually, you know what? Let's tape read the 15-second for today. Keep the 5-minute open as well. Does the SMT with previous day high mean anything? I wouldn't look at it as, I'm still bullish on the day, so I would look at that as Six Sister rather than SMT. You're always going to have SMT on both sides. It's really just a confirmation tool. The more you try and use SMT as a first look, as like a first responder for flipping bias, you've got it wrong. So I would say use SMT as more of a confirmation once you've built everything, and then step away from it otherwise. It'll give you some clarity of mind because there's always going to be SMT everywhere. So, but it is a good idea to start looking at that kind of stuff. But exit SMT, like when I'm looking at, I'm trying to go long off 9:30 up until like maybe this buy side. The least thing I'm concerned with is exit SMT, meaning like where are we at? 9:30. There we go. Wait, not 10, 15, 10. That was right. So 15-second imbalance there holding. Actually could see the mitigation block in here being used. There's no clean gap though. Yeah. So watch we trade up into the hourly imbalance. And if you can get a silver bullet entry, then I would like to target all the way up into that 1 minute. Finally got a 1 minute gap here. Now people are probably scared of the 15-second. It's the same price action. It's obviously faster, sure, but the 1 minute, 15-second, same data, same thing as the 5 minute. That's why I always have the 5 minute pulled up. 5 minutes going to be the best lower time frame chart to read off of, and everything that I use on the 1 minute, on the 15-second, all pairs to the 5. So if I don't have a good reading on the higher time frame where my bias is going, you can't look at lower time frames and expect to know and understand what's going on unless you have higher time frame knowledge. And that's why it's top down instead of bottom up. So unless we have an imbalance below this, which I don't think we have, I can drop down into this bullish order block. But that's really all I wanted to see. It preferably should leave this gap open. If you can tag the bullish order block there. It depends on what stage of price delivery we're in. I don't know if there's a gap here. Let's just swing high. So we could drop into a retracement. I'm not sure. Let's see if we hold this order block. Holding it pretty well. This next candle prints away from it, then I want to print it close away. Then the buy side or the hourly imbalance will be tagged. If we drop below the order block, look for a retracement, which I'm expecting would be this gap, but be this dealing range here. Yeah. Closed out of it. I need to see some displacement. No displacement, then look for a retracement. So the technique I'm using here is we have a draw on liquidity. We know where price is going, and we're on the 15-second chart, and we have a bullish order block with a gap there. So notice how we're respecting mean threshold there, and now we're going to drop into 50%. So the logic there is when price is expanding, what PD array should it hold? The PDF guys should know this. It should be the bullish order block there with the inefficiency. So if we drop into that, we respect mean threshold of the order block, which is really the last line of defense that I'm looking for. Then to me, we're going to continue accelerating and moving quickly with speed off of the gap in the order block. I like to look for reactions off of that though. I'm not trying to pre-fire that and get in unless I already know we're in an expansion leg, which is sometimes why I'll take order block entries. Other times when it's dropping, as soon as I see it failing to respect that order block, I know we're most likely going to enter the stage of retracement. We're not going to go into reversal because we haven't tagged the higher time frame PD array. So I want to see a retracement. Retracement is the most recent dealing range, high to low, which you could use the 15-second or you could use the 1 minute. So if you're using the 1 minute, it would be down to here. 15-second, like I said, would be up to here basically. And that's the most recent child dealing range, the absolute minimum you want to see a drop into discount. It could drop further than that, but that's basically the minimum. And you can see there's a bullish order block also that lines up with that leg, right? So you're expecting it to drop a little bit further into this bisi here, tag the order block, and then based on how you respect 50%, there you go. Does it want to move out of it? So now I'm looking for a potential sys-D. Does it want to tag the order block and tag 50% and displace away? If yes, then I'm consider entering a demo here just for the purpose of teaching, where you can kind of see the fractalness of the market maker buy model, market maker sell model. So you could look at that swing high, you could look at this down closing candle, two of which would be violations of the sell program into a buy program. So we've got a swing high there now, right? That'd be a market structure shift. You've got this up down closing candle, which would be a sys-D. I'm looking for specifically what? Not just a random wick or tick above it. It needs to have displacement. So now at this point, I don't really care sometimes how far my draw on liquidity is up here. I'm not trying to short it. I don't care how far below equilibrium it can drop, because like I said, it could be the 15-second dealing range. It could be the 1 minute dealing range. Like it could be this one, right? And it maybe wants to drop into this fair value gap here. I'm now just waiting for the reversal. So when I see the reversal signature, I see maybe a bisi that forms. That to me indicates that price has already finished its drop lower and it's willing now to expand. Start its second expansion leg. So I can trust whatever low that was formed there is going to be the end of that retracement leg. And now I can use things like bullish PD arrays to get into the move as it targets whatever its new high or low is. So we've got this as well. We've got almost 3 different examples of violation of order flow. So we'll be watching this one first. We'll just tape right here on the 15-second. So we close above that. That would be a inversion fair value gap. I want to see at least a shift above this swing high, preferably above this swing high. Why would you not expect a run of that low below equilibrium to be ran? Oh yeah, it could be. I'm just not anticipating that. So there's your shift. So potentially you could buy in there, place a stop loss at the low of the range. Obviously you could be waiting a bit longer for an inefficiency to form, but now we've got a shift above a short-term high. We've got an inversion for value gap being traded through. And now we also have a sys-D, a very, very tiny sys-D. In this case, might get stopped out, and it gets stopped out. But that would be the framework basically you're looking for the trade model. It's a very lower time frame fractal market maker buy model on a 15-second chart. You've got the same exact logic there. So you're waiting for retracement into a 1 minute gap. And if you wanted to, you could wait for a shift away. Got the displacement there above the swing high. And then a retracement into a bullish PD array. And the bullish PD array in this case would be the inversion fair value gap. Doesn't work here. Obviously, I don't have a major key aspect, which would be time. So I favor if that was a macro time. And you might actually see it continue to move out of this. But that's the logic in mind. Right? And unfortunately, there's going to be things like this where you get stopped out. It's still a valid teaching opportunity. So in this case here, you dropped into that gap there. And you're looking for the same thing. And you could obviously drop risk if you wanted to. Re-enter on the idea. And I still think that this is the draw on liquidity. So just because you flip or you take a loss doesn't mean that the idea isn't still there. You can see even this is not a true dealing range. This is actually the dealing range I would favor. But there's no, I'm looking for an intermediate term low or some sort of long-term low I can anchor my fib to, my retracement leg. It's very hard to trust these kind of random swing lows in a sense. I want to see a stop run. So preferably when I'm drawing my fibs, I want to see a stop run or an intermediate term low. So like in this case, this is the low I would use if we were trying to drop into some sort of dealing range discount here. That's the low I would use. Why? Because it's an intermediate term low. We ran out a swing low there. We also are trading into a gap, and we've got a swing low to the right of it. So that's a very true intermediate term low, and that would be the anchor point I would be watching for on a potential long opportunity. So in this case, same thing. We're starting to get a shift above here. Now we actually have true displacement. I may have been too quick to the trigger there. We've got it respecting the lower part of this inefficiency. Finally got an intermediate term low being placed in. Bisi there drops into it, respects. You also have a sibi here, so you want to see this respected. With the inefficiency, and I could go long here with two contracts and just see if it wants to dig up into that. If it gets one more drop down, I'm tempted to. And if it stops me out, then I'd be done for the day. Tagged it slightly there, but I want it slightly deeper. And there's your bisi tagged. So a little early to the trigger, but nonetheless, there's your same exact framework. You can see it in there, right? Where it drops down. Unfortunately, we had a stop run, which is, you can't do much about it. Then same exact idea. Market structure shift, displacement, shift away from a 1 minute PD array, 15-second fair value gap, tagged into with the sibi fair value gap there. All right, someone banned the admins. I don't know what the heck this glazing is going on. How do you time these guys out? Someone time them out. Thank you. Who gave these guys perms? But yeah, I hope that makes sense, right? So idea there is we're looking for expansion legs in price action. It doesn't expand. What do you expect? Retracement. So if I'm expecting a retracement in price, I'm looking for 50% of dealing range. This is all kind of advanced tape reading stuff, but I still think it's necessary to learn it because it gives you a good idea of when to use certain entry techniques. So there's 4 that I've covered, right? I mentioned in the entry type 3 video, if you've seen that, there's 4 different entries that you can get. And preferably you want to be targeting 3 of them: retracement, reversal, or expansion entries in price, correct? So what I see, I'm looking for, basically my brain goes from, is it expanding? No. Is it retracing or reversing? Which one is it? Has it tagged the higher time frame PD array? Yes. Then I know it's going to be most likely a reversal signature. But retracements and reversals, the signature that you get that you're trading is almost identical. Which is why on a classic London protraction profile and a New York Open expansion, or New York Open reversal, sorry, when New York is retracing or it's reversing, which that's both the same. It's the same profile, right? Think about this. Think about this is midnight and this is a 15-minute chart. We're dropping into New York and New York expands. That looks very similar to if this was New York and then we have a retracement during this was midnight. We have a retracement during New York and expands away. This same signature in here, what I'm looking for in here is the same signature you get on the weekly. It's the same signature you get on the daily. It's the same signature. What do you think is probably down here? Or possibly over here or something? SMT. All right, so if you go to the 15-second chart, we can look at the SMT on those lows because it's the same fractal model. Oh, wow. It's the same thing. So what you look for on a lower time frame is the same thing you look for on a higher time frame, the same thing you look for on the daily, on the 4-hour, everything. It's all a fractal nature. And once you understand what it looks like, it's so easy to trade because all you're trying to scalp for at that point is retracements or reversals. And that's it. Let me actually screenshot this and put it into stream trades before I forget. Did it screenshot? Yes. Okay, nice. And so once you learn to trust this and trust your analysis, you'll then pick up basically the different entry techniques. In the beginning, this is all you want to need to know because this is all you're going to know. It's either going to be, look how this is a reversal signature. Notice how this is a reversal entry, right? A breaker. Meanwhile, this is a retracement entry, just longing inside the fair value gap, inside the short-term discount that we mentioned, right? Tags below discount right there. So that's what you could be using. And then once you get more advanced and you understand how expansion entries work, then you can look at this as, okay, is price expanding? Yes. Do I use an order block to enter in here? And is that something that I'd be willing to lose on? If the answer is yes, then you can try and test it out. If you want to wait for a fair value gap, which is what I would suggest most people to do, that's going to be the best bet. Because as you wait for a retracement into the gap and you pair it with a order block, or you pair it with a breaker, or you pair it with 50% of a dealing range, you now have this added confluence of why that trade is likely to play out. And I still think we're holding this gap. So I still think that potentially we're going to go up to that opening range, standard deviation. But it is very, very, this is how you can just tear up these markets, is by approaching it with the same kind of framework of knowing, first of all, knowing when you want to execute, when you want to stay out of it, and then just looking for the very similar signatures. I know you're not supposed to pattern price, but your entries at a certain point kind of have to be patterned. You can only use so much logic, and I guess you won't actually be patterning it. You're still using a logic in mind. But in the sense of this reversal signature, you can visualize and see. But the only reason you can see it clearly is once you understand where it's going, right? This kind of looks like a market maker submodel. Someone's going to look at this as, oh, that's a shift, that's a SysD, but you're just looking at it for pattern's sake. You're just looking at the candles. You can't be looking at just the candles. You got to look at, where is the higher time frame bias? What's the narrative? What stage of price delivery are we in? What's the time of day? Is there SMT? Is there SysD? Is there all this other stuff? Then you've got a high quality model. Got the smooth highs being left up here as well. But we'll watch it trade up into 1030 here, expecting a new high post 1030. Comes the new draw on time. Probably into noon as well. Like for this scenario, I'd be fine if it drops into this gap. Why? Because the supporting bullish order block would be here. So if it wants to drop into that, that'd be fine. I would favor if the inversion for value gap here is being used as a bullish PD array. And you can see the candle bodies all respecting that for the most part. You have an implied dealing range here. Displacement up there 50%. So if it drops back down into a gap or into the order block, I would potentially use that as an entry up to that swing high. Or even up into, yeah, slightly above it. I know I'm getting kind of carried away with the fibs. I apologize. But this should be used as an inversion for value gap as well. I don't want to see it traded into and respected. Can respect it originally, drop into the bullish order block that's lowest. So this one here, got a gap. Watch it drop into there. It should drop into, respect it with the bullish order block. I do not want to see this low taken out. I want to see that hold there and then accelerate up into now this new swing high. So now we should, the candle bodies, I want it to stay inside the IFVG. If we do not see it stay inside the IFVG, it has to stay above the bullish order block. So at this point, this is where I do not want to see it cross. So this would be, I guess, a visual stop loss. And this is where I want to see the most reaction out of. The bullish order block with the inefficiency paired inside. And I want to see the candle bodies preferably stay above in the, at least inside VG or above the gap. As soon as we start closing and tapping into the, even the open of this bullish order block, I'm starting to rethink if it wants to move at this time, right? Because your drawn liquidity can be right, but the time of day could be incorrect. Prime example, this drawn liquidity is correct. Time of day, it's got to move one back time, one time lower to create the SMT, and then it moves back up. And there's going to be occasions where you can't really do much about that. So it just tapped into the bullish order block and into the IFVG. Candle bodies are staying within here. So candle bodies tell the story, wicks do the damage. Wicks is where smart money gets filled in. Wicks is where there's inefficiencies in price action. But the candle bodies will tell you all you need to know about the current PA. So in this case, look how we're dropping further down than the mean threshold in the open of this bullish order block, down into the IFVG. That's a little bit too far into discount. I want price action to expand. Candle bodies are still holding there, but I want price action to expand. You can see with this IFVG, this is a future IFVG. Hasn't used it yet, but I'm banking on it's going to be used. And you can see how far we closed up on this high, or we even wicked past it. But I don't like this consecutive candle closure into the order block, into the IFVG. It should be holding up. Getting a drop into discount here, but to me it's like there's your wick out on the swing low. Now the reason I'm not looking, because what's inefficient in here? There's nothing that needs to be efficiently tagged into besides this gap, and that's way too far into discount. I want to see that preferably left open as a breakaway gap. This IFVG is really, it's already been rebalanced. So in my mind, that's why I have that as a stop loss order or as a point of invalidation for the idea. And you can see we're dropping further down than I would like it to drop into. So point of invalidation is something you also got to learn on where to place stop losses. Not too tight where you're strangling the position, not too wide where you're allowing it tons of wiggle room. It's got to be in the sweet spot of basically where you're expecting if that point was to be crossed, it's going to fly now. And like in here, stop loss would be potentially below the order block or below there, and then it speeds away. And yeah, like Maddie said, at this point, this looks very like consolidation to me. And the best thing you can do in consolidation is to zoom out. You want to stay zoomed out. 5 minutes, much clearer to see what's going on compared to the 15-second. And now it just looks like we're building consolidation in here. Probably have a run on stops and then a shift back up. Would not be surprised if this gap gets traded through. But yeah, this would be engineering liquidity. You're waiting for the same signature. Engineering liquidity, shift, right on stops, shift, or engineering liquidity, shift, drop X into it like that. That's really the only two possibilities out of a consolidation range, right? Either a raid on the opposite side and then a continuation away, or just a continuation away, retracement, continuation. Consolidation, expansion, reversal, or retracement. This is a reversal, consolidation, expansion, retracement. So you can kind of visualize what your stages of price delivery looks like and how it affects it. But this is exactly why in consolidation ranges, it's very hard to trade because every single time it starts to expand, you're like, oh, maybe this is the time it wants to move. Or, oh, maybe this is the time it wants to move. And you're never right. So every single time you want to be trading, not in a consolidation, but when a consolidation forms, you want to wait for the ranges to be purged and reverted, or purged and you see a gap forming and a continuation. Then you can trust that we're leaving the consolidation. So when I've got a consolidation range like this, I'm bullish. I want to see the lows ran out with SMT and then a shift away. If we have a raid down here on ES and SMT, and then it forms a gap and a shift or a SysD or something, preferably it's got to be up here. I want to see it up there because then I know, okay, we're leaving that consolidation range. We've already raided it. We've got SMT and it's starting to leave. I can get in and trust that it's not going to re-enter that consolidation. Now, periods of prolonged consolidation is why low probability days exist. You have an entire day where it's basically generating liquidity for a later move, i.e. Thursday pre-NFP. That day, even if there's 8:30 news, which most times there are, that's a day where I'm expecting the entire day to be a consolidation profile. So there's going to be times I come into the market, I'm going to think I know where it's going, and then it's going to give me a false signal to flip bias. Then it's going to give me a false signal to enter, and then that entry would be stopped out. Then it's going to give me a false bias that I'm going to get wrong. And then there's going to be so many different things in there that's going to be hard to read that I would favor just sitting out. And everything you can learn from those low probability days and when you're starting out, and when I mean starting out, I mean less than a year experience. If you don't have a year experience, I truly don't think it's super, super wise to try and be, first of all, trading a low probability day. There's absolutely no reason. And second of all, it's really up to your discretion. But if you find yourself over trading or breaking your rules on low probability days, I would say you just simply avoid them. There's going to be days where you misidentify them as high probability and low probability, and that's perfectly fine because there's only so much things you can control. But rather, if you know it's going to be a low probability day, sleep in or go do something in the morning. Maybe you just continue to wake up when you normally wake up, or you have some other activity you could be doing, hitting the gym, maybe making breakfast for your family, or doing something productive, or even maybe something unproductive. But if it keeps you disciplined and not trying to trade, then I would say that's a win. So if sleeping in is the way, it's for me, it's kind of the way now that if I just sleep in for another 30 minutes, then I don't really have the urge anymore to try and wake up and get into this flow of trying to trade. So if I'm like, okay, I already missed 30 minutes of price action, I wake up maybe at 10 o'clock, then I'm good to go. I don't gotta, and I'll only look at it maybe at 15 or 1600 after the day is printed. And then if I want to study it, go back into it, look at what's going on. But normally I will do that just to kind of frame myself with a weekly perspective. Then I'll go in and do that. But it's no rush. I'm not missing any moves. And it goes back to the talk we had about last week about the operating from a sense of abundance rather than a sense of scarcity. The more that you understand that this market will repeat on a time scale, it'll repeat in a price scale, it'll repeat every single day of the week, and you know when your model is going to be there, you can stop worrying about individual days, individual outcomes, and missing moves. In the beginning, the only idea that you have is FOMO. You feel like it's just going without you. This guy's reading the tape, reading the 15-second chart, and you can see these huge moves. And it's very easy to get caught up in that because it's human nature. But once you can kind of separate yourself and you look at it as an observer rather than someone who's getting swayed by the candles, you're just observing price. You kind of stand away from an outside perspective as a spectator, and when there's something that you like, then you can get engaged. If there's nothing in there that you like, majority of is waiting and not engaging. People think it's the other way around, right? You see these profitable traders with win streaks or of days where they're trading every day. Most people are not doing that. And you don't have to be doing that, right? If I can work one day a week and I can hit my entire weekly goal in one trade, why would you not opt to do that? Doesn't make any sense. Because there's also this misperception that you have to work a lot to get this, which is true. In the beginning, you've got to learn. You've got to put in the time. And there's nothing but hard work and a mindset that will get you exactly what you want. But as you progress, you'll find that the work that you once did is not what's needed anymore. You don't get to spend 4 hours a day learning new things. You don't get to spend 3 hours watching ICT videos or whatever you may be doing. It's more of just refining down the mental aspect of it, so then you can actually trade properly when you need to, and you're managing those emotions and manage your expectations. So at this point, I do think if we can get another shift above here into the IFVG, I'm looking for a bisi to form inside that future IFVG. Well, there you go. Then I'd be bullish up into that swing high. I would say we're going to leave the consolidation range. If you can get this tiny bisi here, I want this candle to close healthy. Then we're guaranteed to hit that high. There you go. So I'm looking for that swing high to be ran. Tiny fair value gap here. I don't care if it overshoots it. In my mind, now we're going to be using that lower portion of the IFVG. Algorithm's going to be retracing back into that fair value gap one last time to offer fair value. Maybe drop into the order block or the breaker one last time. And then it should continue back up into the swing high. Especially if the 5-minute looks healthy, which it does. Yep, there you go. Respecting the bisi. And now majority of this IFVG has been traded through. So you expect maybe one last wick into the upper portion. Let's see if we can get a wick down to the upper portion. Release. And then a spool to buy side. So I'm looking for, there you go, wick into the upper portion. And then spool to buy side. Gracias. Magic, right? Yay. Anyways, so when you get good at the skill, it doesn't matter what time of day you look at it. It doesn't matter what kill zone you're in, what price action you're in. I can read low probability days. Okay. I just choose not to. And there's power in that. The confidence that you have in your model to basically see these kind of days, understand that you don't need them, or days that I don't like to trade, I'm not going to trade them. I can trade them. I may know where the bias is on those days. I've got 2 guys that I'm privately mentoring, and I'll tell them, here's what the draw on liquidity is for this day, even if it's low probability. Like Monday, I told them it was going to trade it to the new week opening gap, and that was my bias. And then going into the day, I could frame shorts more than I could frame longs. So I'm like, why would I be streaming this day? Why would I be trading this day? It's not worth it to me. Like I'm in here to win, and not win a trade, but win in trading. Right? You're looking at it as a trade by trade perspective, and that's not the perspective you want to have. You want to have, okay, how do I win in trading? As the game of trading, how do I win? It's by doing the things you got to do and you're setting yourself up for success. Is trading a Monday with no news after a new week opening gap of 300 points and the news the next day something that over a long period of time going to present me profitability? No. From my own experience of what I've seen in my model, I know that I'm likely to take a loss on that day, even if I know where the drawn liquidity is, because of things like this, where there's a lack in precision of time, where maybe this is the 950 macro, and then 1017 drops down, takes out my macro short or my macro stop, and then it spools again. And I'm like, why did it do that? Because there's a lack of precision in both time and price. So it's hard to trade. That's the whole point. We're trading up into this 2 to -2 from the dealing range here inside the gap, and you're still looking for that opening range -1 standard deviation. Just as a fun play, this is not financial advice, this is on demo hypothetically. I took one little Roblox short option just for fun because their earnings come out tomorrow. I'll let you know how it goes tomorrow or on Friday. I saw it. I was like, you know what? I haven't done options in a minute. like $100 or something. So it's not anything huge. But just to spice things up, because January's been boring. Will I be streaming tomorrow? It'll be based on PA. So yes, no, depends. By the way, for the read here, I'll explain exactly what I was looking for. So this is a advanced tape reading with flux trades. So obviously, yeah, we were in that consolidation range. This is purely from the 15-second chart. You can kind of derive this data. 5-minute, in this case, dropped into that 1-minute gap again and printed away on this 1030 candle, right? So a healthy candle to 5-minute, meaning it's towards my bias. We've got the smooth highs up here. We already knew that was the draw, and the gap, we already knew this was the draw. So we tagged into the 1-minute gap, and then we displaced away. We've got a sys there with an inefficiency, and we're respecting it. So to me, what I said was, if I see this secondary displacement, if you think of a market maker model, you've got the smart money reversal, drops down, displacement, retrace into it. Normally there's going to be consolidation and then displacement again right before the second stage of distribution, right? So even if this doesn't line up with -2 to -2.5, which it kind of does there, but in here it doesn't. That's what I'm visually looking for. So when I see that this secondary displacement happens, I already know that this gap has been traded through efficiently, meaning we've got both buying and selling, only except this upper portion. See how we're missing data there? There's no black candle or green candle in there. That'll be used for later. So when I see it's respecting now this fair value gap, I mean, now we have a stop run in there, and we have displacement away through this. We have a market structure shift, and we have a fair value gap. And I told you I was looking for, if we can print this candle healthy and we've got a gap there, I would assume that we're no longer going to be trading lower. We're going to target this high and spool away. It drops into it. What does it tag? The inefficiency. Why does it wick lower than the gap? Order block. Down closing candle before the move up that created an inefficiency. And then we spool away from that. Why did I mention that this next candle is going to open up, tag into the upper portion of the IFVG, and then trade back up? Because if you look at the entire inefficiency, I told you we have efficient buying and selling up into this level. Right? Up until there. Extend that out. That's where I'm looking for price to have a reaction from in the gap, because that's inefficient. So as it trades up through there, now we've got complete buying through it. I would favor if there's a down closing candle that prints right there. I know that's not going to happen as we're in close proximity to this buy side. This works like a magnet, right? So as we get closer and closer, price is not going to want to retrace a whole great deal. So that's why I'm expecting this next candle to drop into the upper portion of it and then spool away and take out that buy side. So advanced tape reading techniques, you do not need. I'm going to always say this because it's very intimidating for a new person to look at that and be like, how do you read that? It comes with time. It comes with skill. Okay. I've had no access to any data outside of public ICT content in my own studies, right? It's just time in front of the charts. So as you do it over and over and over again, you recognize the patterns and you recognize how the candles print. I don't normally trade the 15-second chart. I trade the 1 minute. But this is exactly, if this is the 1 minute chart, that's exactly how it's supposed to print. It's the same candles, it's the same data, it's the same algorithm. So why would it be any different? It wouldn't be. It's just more data. We've got more candles in here. And sometimes it's just, you can, once you understand it, you can trade on that range. And now at this point, we've tagged up into the inefficiency. Right at the stops here, you could actually see, look for a potential retracement into TGIF of this range. So back towards these sell stops to soup and then come back up. Framing that final piece in the -2, -2.5. Yeah, a couple things I'm framing why it's going to retrace. I'm expecting to. TGIF I mentioned, that's one. Two would be the fact that we have this original consolidation, be lower, higher time frame PD array. That's expected to be ran through. But because it's a key time, 10:30, a lot of times when we've been expanding from 9:30 to 10:30, you have a retracement on stops formed throughout the session. Very kind of niche tool to use. But when 9:30 to 10:30 expands a great deal, you look for retracements back into the range after 10:30. So either a turtle soup at the extremes or some sort of retracement if we haven't taken out that high yet before it expands back up. So I'm expecting that these relative equal lows here should be souped. I don't know if that's going to be the exact level it tags and then trades back up, but I'm expecting at this point we drop into the range. I would not like to see it drop all the way into discount, but using the framework there of just to stop run at least relative equal lows, 5 minutes, 5 minute swing low as well. Relative equal lows there, so it wouldn't be unreasonable that we drop into that. Anyways, so that'll wrap up for me today. Just kind of a small tape reading stuff and tips and tricks, not a major day. Tomorrow, so NFP protocol states that Monday through Wednesday AM is where you want to be looking for setups. Thursday, you want to skip. Really between Wednesday PM and Friday 8:30 is where you skip. So Wednesday tomorrow, we potentially will have a stream based on the price action. I'll try and get a daily bias in early, and we'll start the stream probably at 9:30 there. We have 10 a.m. news again, I think tomorrow, if I'm not mistaken. Thursday, there will be absolutely no stream, no daily bias, no predictions. I expect you to take the day off. I want you to take the day off. And this comes with a psychological learning lesson as well, where there may be good moves on a low probability day. You should not care. You don't care because anything outside of your model is what? Noise. So just like how when you're trading the New York session, the Asian session or the London session may look good, but if that's your model, that you trade just the New York session, then that's noise. Just like how just because you show up at 9:30 does not mean that you're going to get a move. So on low probability days, there's an opportunity and chance sometimes that there is a setup there. But the reason that you don't take it on that day is because you're likely to lose. You're likely to lose. Even if the setup is there and perfect, there's probably something that you didn't take into account on a low probability day. And it disrespects all the order flow, and then boom, you get stopped out. And then this comes with this psychological reason as well, this coping mechanism of over trading and over leveraging, because especially if you knew you were not supposed to be trading on that day, you took a trade, you took a loss, that is a bad loss, right? That's not a loss that's within your model. It's not a loss that you normally want to take. So that can produce pain, and that manifests through coping mechanisms. And your coping mechanisms are over trading, over leveraging, breaking your rules. So it's better to just sit out. I don't care if there's a move there. I don't care if I miss a move. I don't care if it goes 3,000 points and there was a clean macro setup. That's not my model. And it's not something that I want to be willing to put in a trade. And you've got to understand that you're going to miss moves. People are going to trade on Thursday. You're going to see people post screenshots of wins and losses in this Discord for sure. I guarantee you. You will also see probably on Twitter, but you need to understand how to block out the noise. You're going to see that. What do you got to think? That's great for them. They must be trading some other model that I don't trade, but that's not my model. And you should get confidence in that. I like you should have the confidence in your own discipline of like, that's great. You made $3,000. I'm happy for you, but this is not my model. Therefore, I'm not going to touch it because I know what happens to me. And some of you will have to get burned by that to understand what I'm talking from here. But then those who can actually take the advice from ICT, from other people, and be like, yo, this is where I fell before. Don't do this. You should probably take the advice. I have traded on NFP before. I have literally blown accounts pre-NFP because I was undisciplined in trading it. There was a model there. I could probably go back and find the screenshots. There's a model. I used proper risk. I got in. I lost. But because I knew I was not supposed to be trading on that day, it created this gap between your expectation and your reality. So I wanted to win. The more that you need an outcome, the more you're going to hate what it produces for you. If you hate losing, you're going to hate losing when you lose, and you're going to keep constantly trying to fight that loss. If you like winning, if you want to win on a trade, if you're expecting that a trade is going to win, you're wrong. You're wrong. Of course, you want the trade to win. Of course, you want to make money. But when you get in a trade, you do not know what the outcome is going to be. And anyone who's in here or anyone who says that they know the outcome of this trade, even if it's high probability, is lying. You can do fancy stuff like here, watch this, or here, watch how, and it looks cool on the 1 minute. Like when I'm in a groove on the 1 minute on tape reading, it looks like magic. I still am like, I look back at the recordings, I'm like, this looks, if someone does not understand ICT, this looks like I know the market. Or anyone else, if you've tape read the 1 minute and you've called out levels, even on a daily bias perspective, it looks like you're reading the market. But I get it wrong. Case in point, I read the market wrong. So expecting individual trades to be winners or losers, more importantly, winners, is going to have a bad fluctuation in whatever the outcome is. So you have to desensitize yourself from the outcome. That means both the winning and the losing. So it's very hard to do because in the losing, you want to hate losing. You don't want to lose. But in the winning, your body's going to be like, yo, we just made X amount of money. We should be happy. We should be celebrating. We should be sharing this. But you must learn how to control your mind and your reaction to those things. And that's why you have to understand that individual outcomes are random. They're random. You don't know when you flip the coin if it's going to be heads or tails. That's why you flip it in the first place. Right? If you knew what it was going to be, you wouldn't flip the coin. You're basically saying, oh, it's like betting on a coin flip. In this case, your coin is weighted, but you don't know the individual outcome of the coin flip. So you have to protect yourself. Right? Obviously, I want it to have, when I flip the coin, right, there's a experiment that you can do of like, if you have a decision to make and you don't want to make the decision, you got to flip the coin. Typically, when you flip the coin, while it's in the air, you already have the decision in your mind that you want, right? So every single time I flip the coin, of course I wanted to win. But what do I care more about the feeling of wanting to win or the what is? The what is the outcome of the trade. It can be a winner or a loser, but you have to understand that if you have a win rate, if you have an expected trade outcome of over 100 trades or over 10 trades, if you have an 80% win rate and a 2R, you're smashing it. You're killing it. So putting it in perspective sometimes of that, of like, you need a 40% win rate and a 2R to be profitable. That's so easy. For most people, that's like, you look at that and you're like, I can be more wrong than right and still make money in this and make this my job. This just sounds crazy. And the problem is your ego will hide that from you. Your ego will not allow you to be wrong more than right and to make money out of this. And some people are in this to be right and wrong rather than they are to make money. So you actually care about the losing and winning. If you actually care about making money in this and making this your job and making it a profession instead of a hobby, then you'll do the things that are necessary to succeed. You focus on the process and you stop caring about the outcome. Because everyone who follows the process, it's a manuscript to success, right? Everyone who's done what they need to be doing in trading has all been successful. You've never seen someone who has studied, who has taken time out of their day to look at this, who has created a model, who's backtested the model, who has written notes on the piece of paper on their desk of what they're going to do after they take a loss. Review the trades or review your model before you get into the charts. Have a good daily bias. Journals before, during, and after. You're not going to find someone who does all that stuff and fails at this because it's not a thing. So some people want to get there so quickly, but then don't actually do the things that are necessary to take them there. And to be completely honest, I don't want to step on anyone's shoes, anyone's toes, but your excuses really are not excuses, right? Because there's someone else out there who is hungrier than you, who wants it bad, who's in a worse situation, who had no money, who had no running water growing up, right? There's people literally in Africa who are making this their job. I've taught people over in Uganda who literally have not had money for mentorship. And I'm like, here, go watch these videos, go do this. And they're doing well for themselves. And they sometimes wake up, and I'm sure the people around them, maybe not them, but there's people in their country who do not have clean drinking water. Right? And we're sitting over here in our nice chairs, looking at our screens, probably got a cup of coffee, you're probably in a warm house, and you've got excuses. That's just the reality of it. And it's going to hurt. And, some people are not going to want to listen to that stuff. But to be completely honest, you have to take full accountability in this. The reason you're not succeeding, or the reason that it's taking longer, is because you're not doing the things that are necessary to succeed. And that's it. So that should be a wake-up call for some, but it should also give you confidence, because you're like, there's nothing else in this that is going to make me fail besides me. Right? So it's no one else's fault besides you, which for some people that's scary. Other people that's like, that's the best thing ever. Because I can now take full accountability. If I take a loss, sure, it's my fault, but I don't have to worry about that individual loss. Did I do the things that are necessary to get to proper trading? If you're not journaling, if you're not screenshotting price, if you're not waking up earlier enough, if you're not avoiding the days you need to avoid, if you're not trading the days you need to trade, despite whatever the outcome is going to be, you're not going to succeed. There's no shortcuts to this. I can give you Enigma, and you may have a 99% win rate, but if you have that 1% that you take a loss and you know how to manage yourself, account is gone. Right? That's why alerts, so people who do signal services, it doesn't work. And that's why I'll never do it here. Because people who do a signal service, I may give 100% correct signals. I'd be like, here, buy here, sell here, place your stop here, play your TP here, every single trading day that I take. But it's not going to work, because people who lack discipline will take trades outside of that, will move their stop wider, will move their TP wider, will not close out the position or enter the position when I do it. And then I'm going to be liable, or even just feel mentally responsible for their losing, when in reality it's just their fault. And I don't think there's any teaching in that. There's some teaching that can be done of taking demo trades, and I'm not going to sit here and say there's no point. But there's a time and a place for everything. So there's a lot of work that needs to be done for you to succeed in this. A lot of hard work, a lot of mentality shifting. But a lot of that work you'll find is outside of the charts. It's outside of it. The times that I've had winning streaks and done the best in my trading is when everything outside of trading was perfect in my mind. Not perfect if everything was going right, but I had a system. Like January, December, I kind of stepped away from the system because I wasn't going to be trading as much. So I traveled a little bit. I went on vacation with the family. I went and saw things. I went and hung out with friends. I kind of stepped away from trading. And there's times and seasons for that as well. And so I can kind of relax from my system. But now as we're getting to spring, I know I've got to get back onto it. I've got to wake up at a certain time. I've got to trade if I have to trade. If I don't trade, I'm still doing the minimum of you still got to journal and do all that stuff. But now I'm getting back to a proper daily schedule of I've got to read at this time. I've got to work out at this time. I've got to do this, and this, and have kind of my days scheduled from like every 15 minutes, that kind of schedule. Because to me, having that rhythm and knowing, okay, at this time, I've got to go and do this, whether I like it or not, helps build discipline in trading too. So I know my trade frequency is going to go up, meaning I need to have more mental capital. And the way you have mental capital is by automating things in your life. If you can automate things, it's very easy to then kind of have this leftover mental capital you can use to spend on proper decisions. And what you'll find is the more and more decisions that you have to make, the less high quality those decisions become. That's why pilots have a handbook. That's why Navy SEALs train a ton before they enter into an op. Right? Before they go into an op, they've got to train where they trust their weapon system, they trust their skills, so that when the decisions they make, it's not how do I reload this, it's how do I drag this guy from point A to point B and not get shot. It's like actual, thinking that you got to do. So in this kind of scenario, right, when you take a loss, you're going to enter into survival mode. And you have to understand how to properly manage your response to that emotional stimuli and how to think properly and make good decisions under that stress. So in the beginning, it's going to feel like everything stresses you out. And that's a lot of that is desensitization. So you've got to be in it for you to experience that kind of stuff. So that's why I think demo trading live and, taking losses like this, some people are going to freak out over that. And I think it's good to just be stoic about it, just not care. Right? You don't ever see me overreact to wins or losses. I'll be sarcastic when, there's a level that's called out or something that does exactly what we want it to do. I'll be sarcastic about it. But you never see me, the people who are overly energetic, you got to be kind of somewhat skeptical of them. I know some people can do it like TJR, but always just got to be mindful of that stuff. So anyways, I've been yapping here for a good, 30 minutes or so. So I'll let you guys get the rest of your day back. I'll post the stream recording up when it's finished. And please, I hope you guys took something from that. So after the day's finished, I'm still bullish for the rest of the day. I would assume we're going to tag up to the opening range, standard deviation, probably by 3 p.m. So look for that. If not, then maybe just consolidate the rest of the day. And that becomes the target for tomorrow. But stream tomorrow will be based on PA, so be on the lookout for that. I'll ping you guys before that happens. But do the things that are necessary to succeed. And I'll catch you guys soon. Peace.